Britain once claimed it had 300 years of coal reserves, yet within a single generation its global dominance vanished and mining towns became ghost towns. The same collapse struck the oil and gas empires, leaving behind nearly $1 trillion in stranded assets. Now the world is betting $500 billion on lithium, convinced this will be the resource empire that breaks the pattern. But history says otherwise. Are we about to watch the cycle repeat faster than ever? The answer begins with coal. By the middle of the 19th century, Britain's coal fields thundered day and night. Steam engines powered factories, railways, and ships, fueling an industrial boom that reshaped the world. In 1850, British mines produced about 2/3 of the world's coal, and no other nation came close. Coal was more than an energy source. It was the backbone of British power, driving exports and feeding the empire's global ambitions. The government poured billions into mining infrastructure, laying down endless tracks and building entire towns around the pits. Streets filled with miners' families, schools, and churches, all dependent on the black rock beneath their feet. Official reports brimmed with confidence. In 1900, government experts declared, "We have 300 years of coal reserves." The message was clear. Britain's dominance would last for centuries. Coal seemed inexhaustible, permanent, and essential to every part of daily life. This belief ran deep, from the boardrooms of London to the smallest mining village. The entire economy, military, and society were locked into a future that revolved around coal. For those living through the height of the coal age, the idea of a world without it was unthinkable. Yet history was already moving in the shadows, setting the stage for a challenge no one in power could imagine. By the 1920s, a quiet threat was spreading through Britain's coal heartlands. Oil-powered ships began crossing the seas, and electric lights flickered on in homes once warmed by coal fires. Factories that had once echoed with the sound of steam engines started wiring up to the electric grid. In mining towns from Ebw Vale to Ashington, the signs of change grew impossible to ignore. Profits vanished as coal struggled to compete. By the end of the 1940s, many pits operated at a loss, and entire communities faced a future with no work and no purpose. The closures came in waves during the 1950s and 1960s. One by one, mines that had run for generations fell silent. Rail lines rusted, and the steady flow of coal wagons stopped. In places like Ebbw, the sense of loss was more than economic. Families who had lived side by side for centuries watched their towns empty out. Unemployment soared, shops closed, and schools struggled to stay open. Streets that once bustled with miners and their children became quiet, their windows boarded up. The coal did not run out. It was simply left behind, made obsolete by new technology and changing demand. Billions invested in mines, railways, and entire towns became worthless almost overnight. What had seemed permanent, an empire built on black rock, vanished within a single generation, leaving behind ghost towns and broken promises. The lesson was clear to anyone willing to see it. No resource, no matter how essential, is immune to change. In 1859, a drill struck oil in Pennsylvania, and the world's energy order began to shift. The rise of oil was swift and absolute. By 1904, John D. Rockefeller's Standard Oil controlled about 90% of U.S. refining capacity, turning oil from a curiosity into the backbone of modern industry. The Model T, rolling off Ford's assembly lines in 1908, put oil into every American driveway and made gasoline the lifeblood of transportation. Ships, trains, and factories, all once powered by coal, switched to oil, drawn by its energy density and ease of transport. By mid-century, oil had eclipsed coal on a global scale, shaping not only economies but the very structure of international power. In 1960, the world's top oil producers formed OPEC to control prices and production, further tightening oil's grip on global affairs. 14 years later, the petrodollar system was born. Oil would only be traded in US dollars, locking the world's most important commodity to America's currency. This single move tied energy markets to the U.S. Treasury, making oil not just a fuel, but a pillar of monetary policy and geopolitical leverage. Governments, corporations, and entire nations built their futures on the promise that oil's dominance would never end. But beneath the surface, the seeds of overdependence were already taking root. On April 20th, 2020, the unthinkable happened. Oil prices on the New York Mercantile Exchange plunged below zero, closing at minus $37.63 a barrel. For the first time in history, producers were forced to pay buyers to take oil off their hands. Storage tanks were full, tankers circled at sea with nowhere to unload. Traders scrambled to unwind contracts, and billions vanished from company balance sheets in a matter of hours. Energy economists called it a financial earthquake. The world's most traded commodity, once the foundation of global wealth and power, had become a liability overnight. Decades of investment in pipelines, refineries, and drilling rigs suddenly looked like a colossal miscalculation. By 2021, analysts estimated that $900 billion in oil infrastructure could never recover its costs. Projects that were supposed to generate profits for decades became stranded assets, left behind by a market that no longer needed them. The numbers told the story. The oil empire, built on the promise of endless demand, had collided with a new reality: oversupply, collapsing prices, and an accelerating transition to electric vehicles and renewables. The financial vulnerability was laid bare, not by running out of oil, but by the world moving on. The collapse was swift, total, and irreversible. What had seemed permanent was now just a cautionary tale, warning of how quickly fortunes can turn when the world's faith in a resource disappears. By 2020, nearly 40% of Europe's natural gas flowed from Russia. Utilities and governments signed long-term contracts, betting on the promise of stable and cheap supply. The Nord Stream pipelines, built at a cost of $11 billion, stretched under the Baltic Sea, linking Russian fields directly to German industry and homes. Natural gas was sold as the perfect bridge fuel, a cleaner, more reliable answer while renewable energy scaled up. Policymakers treated this arrangement as a permanent fixture, weaving Russian gas into heating systems, factories, and power plants across the continent. Investments poured into pipelines, storage, and distribution, all on the assumption that supply would never be interrupted. As dependence deepened, the risks of relying on a single supplier faded from view, replaced by the confidence that the flow of gas and the prosperity it supported would continue indefinitely. On February 24, 2022, Russia's invasion of Ukraine triggered an energy crisis that stunned policymakers across Europe. Within weeks, the continent faced a stark choice: keep buying Russian gas or risk blackouts and economic chaos. Experts said replacing Russian supply seemed impossible. By August of the following year, Russian gas imports to Europe had fallen by 80%. Germany, once the most dependent, cut its reliance from 55% to just 8% in 2 years. The response was immediate and sweeping. Governments fast-tracked LNG terminals, retrofitted ports, and rolled out heat pumps at record speed. Fast-tracked infrastructure and policy changes became the norm. Energy officials pushed through efficiency measures and rewired entire heating systems in months, not decades. Pipelines that were once strategic assets now sat idle. The speed and scale of this pivot revealed just how quickly a resource empire can unravel when alternatives become a necessity rather than a choice. By 2012, the Tesla Model S rolled onto highways, and lithium was no longer a niche metal. Within a decade, the rush was on. Investment banks, mining giants, and governments poured more than $500 billion into lithium extraction and processing projects around the world. The financial media crowned lithium the new oil, and every forecast pointed to unstoppable demand. Australia, already a major player, tripled its lithium output in just 5 years, racing to meet the projected needs of electric vehicles and grid storage. Production expanded by 300%, with new mines opening across Western Australia and plans for even more. In South America, the so-called Lithium Triangle, Chile, Argentina, and Bolivia, became the center of a new geopolitical contest. These three countries control over half of the world's known lithium reserves, buried beneath vast salt flats. Their leaders talked openly about forming a cartel, an OPEC for lithium, hoping to set prices and control supply. Meanwhile, China took a different approach. Rather than focusing only on extraction, Chinese companies invested $50 billion into processing plants, refineries, and battery factories. This gave China control over the step that turns raw lithium into battery-grade chemicals, making it the gatekeeper for much of the world's supply chain. For mining executives, the mood was euphoric. Prices shot from $6,000 per ton in 2020 to nearly $80,000 per ton in 2022. Projects that once looked marginal suddenly promised windfall profits. CEOs flew to conferences, boasting of multi-decade reserves and expansion plans stretching into the 2040s. Governments handed out subsidies, streamlined permits, and offered tax breaks, all convinced that lithium's dominance was locked in for a generation. But the story was already showing cracks. By 2023, lithium prices crashed 80% to $15,000 per ton, wiping out billions in paper value. The flood of new supply collided with slower than expected demand growth and early signs of alternative battery technologies. Yet the capital commitments remained. Mines take 7 to 10 years to build, and projects greenlit at peak prices cannot pivot overnight. Across the globe, from the deserts of South America to the outback of Australia, billions of dollars are now tied up in assets that depend on lithium's continued reign. For the companies and countries betting everything on this metal, the stakes have never been higher. In 2023, a shipment left a Chinese factory carrying something that sent ripples through the global battery industry. It was the world's first mass-produced sodium-ion batteries. CATL, the largest battery manufacturer on the planet, began delivering a product that did not need a single gram of lithium. The difference was not just in chemistry, but in economics. These sodium-ion cells cost about 25% less than their lithium-ion counterparts, a gap large enough to reshape the business case for everything from city buses to home storage. Sodium is everywhere, found in seawater and ordinary rock, not locked beneath salt flats or deserts. For the first time, a credible, scalable alternative to lithium was rolling off the assembly line, not just sitting in a lab. Inside CATL's headquarters, the company's chief technology officer explained the logic. Sodium-ion batteries offer competitive cycle life and perform better than lithium-ion in cold climates, ideal for markets from northern China to northern Europe. The energy density is lower, but for many uses, urban vehicles, stationary storage, and backup power, weight is not the limiting factor. For these segments, cost is king, and the cost advantage is not theoretical. CATL's sodium-ion cells are already in commercial vehicles, with more orders lined up for 2024 and beyond. Meanwhile, battery labs in Japan, South Korea, and California are racing to commercialize solid-state batteries. Toyota, Samsung, and QuantumScape are betting that by the late 2020s, solid-state technology will deliver up to 50% more range, faster charging, and longer life than today's lithium-ion cells. Some designs still use lithium, but in much smaller amounts or potentially none at all. Toyota's public roadmap targets pilot production as early as 2025, with commercial deployment following soon after. For automakers and tech companies, solid-state promises not just better performance, but a way out of the lithium squeeze. Grid-scale energy storage is also breaking free from lithium's grip. Form Energy, a U.S. startup backed by major investors, is building iron-air batteries that store electricity for days at a fraction of the cost of lithium systems. Iron is abundant, cheap, and safe. These batteries are bulky, but for power plants and renewables, size is less important than price. Early field tests show iron-air batteries can deliver power for up to 100 hours. opening the door for wind and solar to run reliably even during long lulls. None of these technologies needs to take over the entire market to cause upheaval. If sodium-ion grabs the low-cost segment, solid-state claims the premium tier, and iron-air dominates grid storage, lithium demand projections collapse. The lesson from coal and oil repeats. When superior alternatives appear, dominance unravels quickly. Billions invested in lithium extraction and processing now face the risk of becoming stranded assets, built for a future that may never arrive. Every lithium mine built today is a bet on the future, a future that may never arrive. The numbers are stark. From the first drill to the first shipment, a new lithium mine takes 7 to 10 years to bring online. Companies and governments poured in hundreds of billions of dollars on the promise of surging demand, locking in plans that stretch through the 2030s. But battery technology is evolving on a much faster clock. Sodium-ion cells are already shipping. Solid-state and iron-air batteries are moving from lab to market in less than half the time it takes to finish a single mine. Consider the timeline. Coal ruled for nearly 2 centuries. Oil dominated for about 120 years. Natural gas stayed dominant closer to 30 years. Lithium's cycle is on track to compress into just 15 to 20 years, maybe less. The pace is not just quickening, it is outpacing the very infrastructure built to support it. A mine approved at the height of lithium mania in 2021 likely will not reach full production until 2028 or later. By then, the market it was built to serve could look completely different. For investors, especially pension funds and sovereign wealth funds, the risk is not abstract. Over $500 billion has been committed to lithium extraction and processing since 2015. If alternative batteries capture even 1/3 of the market by 2030, up to $250 billion in assets could become stranded, unable to earn back their costs. That is not a distant scenario. Australia, after tripling its lithium output in 5 years, is already seeing projects mothballed and expansions paused. Companies that once promised decades of steady returns now face the prospect of shuttered mines and idle processing plants. The mismatch between investment timelines and technology cycles is the silent fault line running beneath the lithium empire. History shows how quickly the ground can shift. The lesson is written in the abandoned coal pits of Wales and the rusting oil rigs off the Gulf Coast. The question now is whether those betting on lithium's permanence are prepared for a future that may leave their investments behind. The clock is ticking, and the pattern is already in motion. Right now, over $500 billion is locked into lithium's future, even as sodium-ion and solid-state batteries move from lab to market in real time. The empire's lifespan shrinks with every new breakthrough. The pattern has not failed yet, and history shows it never waits for those who believe they are the exception. The next collapse is not a question of if, but when. What do you see coming? Share your thoughts below.